Hi everyone, welcome back to the Excel for Finance channel. In today's video, we'll talk about the use case for sensitivity tables in financial analysis and how to create them. In my experience in both investment banking and private equity, the sensitivity tables are the most useful pieces of analysis and are often the areas where the deal team will spend the most time when evaluating an opportunity. This happens because all financial models are inherently flawed, since there are usually so many assumptions that go into each model. This can be anything from growth rate to cost of capital to entry leverage to exit multiple. It's impossible to know exactly the right numbers to pick. And since your model is only as good as the inputs that go into it, two-way sensitivity tables are a great way to see the impact of changing inputs two at a time. Let's go to our first example. An LBO model is short for a leveraged buyout model. Private equity firms often purchase companies through an LBO, which just means they use leverage in addition to equity to fund the transaction. You generally solve for the IRR or internal rate of return when making an LBO model, and then you use the LBO model to decide if this investment makes sense. There are a few key inputs that impact your returns. A few are the price you pay for the asset, the entry leverage you put on the asset, and the exit multiple you think you can sell the asset for at exit. A common sensitivity table is purchase price premium versus exit multiple. Let's make it. In a two-way sensitivity table, you will have one variable across the top and another down the left side. In this example, we have the purchase premium at the top and the exit multiple on the left. It doesn't matter which variable is where. The cell at the intersection of the input row and column, this cell here, will be the output cell that you want your sensitivity table to display. Each return cell in the table shows what this origin cell is if you had run the model with the corresponding purchase premium or exit multiple. So for example, cell V17 is the IRR when you pay a 1% purchase premium and exit at 15 times. One way to check that your table is running correctly is to check that the cell in the sensitivity table that matches the current case shows the IRR that the model is showing. In this case, our model case is a 2% premium and a 16 times exit. So if we scroll down here to the model output, the IRR in year 5 is 18.6. This matches the sensitivity table. To make the data table, you select the full table including your input variable row and column, and then at the top go to Data, then What If Analysis, and hit Data Table. The shortcut for this is Alt-A-W-T. Then where it says row input cell and column input cell, Excel is asking which cells in the model you should sensitize. For us, I have purchase premium in cell E16 and exit multiple in cell H199. Once you have those selected, hit enter and give your Excel a second to refresh. I also like to sanity check by putting another set of inputs into my model. For example, if we put a 1% purchase premium and a 15 times exit, the model should show a 17.1% IRR. Let's check. And that's it, it's that easy. I'll also spend a second to show how to format the sensitivity table to look presentable. This is just your classic adding borders, making the row and column titles bold, fixing the font and text size, etc. And that's it, we have a fully functional two-way sensitivity table. Some other inputs that you could sensitize are revenue growth rates, EBITDA margins, leverage, cost of debt, really anything that goes into your assumptions can be sensitized. I hope this video was helpful, and let me know if you have any questions in the comments below. Please like, share, and subscribe if you liked the video.